The broadcast has started. You are now live. Thank you all for joining the Build Buyer Partner panel. We have some great experience among the team here. My name is Margaret O'Connor. I'm the moderator. I've been working in fintech since before the phrase was established, helping MasterCard set up pioneering use cases for banks in China, India, and Southeast Asia, and helping to build bridges to Silicon Valley, the beginning of e-commerce. We're going to start today with Miguel, who's the head of investment banking for Citibank in Africa. He's had the experience to do a number of IPOs and M&A deals, including Jumia, who you all heard from on Tuesday. Miguel, you want to talk about the M&A landscape and what you see happening in fintech in Africa, please?
Yes. Thank you very much. So my name is Miguel Azevedo. I run the investment banking business in Africa and the Middle East, which is the right combination for Jumia, for example, but it's also the right combination for Network International, who we helped on the IPO and more recently on doing the acquisition in Kenya of DPO on one of the largest fintech transactions in Africa ever. I would say, in a slightly random order, I'll make a few comments. First one is fintech and banks and what's happening in this space. Everybody is getting very attracted by the numbers that we see on fintech deals, right? DPO, $25 million of revenue, $288 million of transaction value. Paystack maybe $10 million of revenues, $200 million. So this is very exciting. At the same time, when you look at banks, you have some of the largest banks in Africa trading at $500, $600, $700 million. So there's a big gap here. Whilst fintechs are being valued at 20 times revenue, the banks are being valued at a discount to the book value. But on the other end, some of the banks, they actually have some fintech business embedded. So there's this tension of why are we not being valued? So I think that explains a little bit what we have been seeing more recently of some banks announcing that they will carve out their digital business. And digital is a proxy for fintech. And so that's one trend I think we're going to see is banks showing their digital business and how profitable that is and how much it is growing. The second comment I would make is that banks are doing this because they already have digital, which they did not have 3 or 4 years ago, or not everyone. So most of the banks have done a lot of progress in this respect. Some have developed their own digital businesses. I would say probably Equity Bank in Kenya is a great example of that. Others have acquired banks that were much more digital than the acquirer. That's the case of Access Bank in Nigeria when they acquired Diamond Bank. And since then, for example, in the case of Access, we have seen a massive progression, a massive move towards digital, where digital is actually the main source of new clients and new business. So banks are learning fast and they are trying to move in that direction very fast, including by acquisition. The third comment I would make is the access to capital. Fintechs, if they are very successful, at some time they have to go either IPO or sell themselves. How can do they do an IPO? And that's where I think we should take some lessons as well from what happened recently in China with Ant Financial, which the IPO was done and then it had to be pulled because of regulatory issues. And being regulated is actually very, very important. I remember a year ago in September, in one of your roundtables in New York at the time, we were in a roundtable, a lot of fintech entrepreneurs, and I was talking about the need to be regulated. Some eyebrows clearly were raised there. What is this being regulated? But it's very critical. if you want to raise capital, or if you want to sell yourself, because that is the way, the flip side of certainty and security. So that's another element that I would say is very important. Finally, I would say that from a sort of a more global perspective, some of the big banks like Citi, we are following the fintech scene very, very closely in many different formats. One of them is talking to these companies so that we can raise capital for them, we can help them on M&A. The other one is we have our own labs, and we organize, for example, in the Middle East and Africa, some contests where companies come and present their business model, and we do workshops around that. Last year, if I'm not mistaken, the winner of that was Fori, which is now worth $1 billion, listed in Egypt. And the other element is, we, as a city, it's not myself and not my group, but we also invest in fintechs, primarily in the US, but globally, but led from the US. And we do that in a sense to be connected into this very creative, ingenious world, and we then incorporate some of those solutions into mainstream business of a global bank. So even the global banks, they are following this extremely closely, of course, because this is the future. And as a final remark, I would make a point. A few years ago, I was going around Africa with a very large Chinese digital / fintech company. And we were asking them if they wanted us to introduce them to banks. And they said, no, because we compete against banks. We cannot partner with banks because our aim is to disrupt the banks. I think that since then, things have evolved, and partnerships and ways of cooperating and building upon each other's strengths. But it's a fascinating world that we are seeing. And the final message is, and building on this network / DPO transaction, where we actually raised $200 million in the equity market in 3 days. The market is open for these stories. The market may not be open for, a power company in Africa right now, but it is definitely open for a fintech business in Africa if size is big enough to allow for a capital market transaction. So it's really a bright spot in the continent, and there's no lack of ingenuity, no lack of entrepreneurship, and I would add, no lack of capital. Let me stop here.
Loved your comment about the ingenuity. Before we move on to the next speaker, can I have some of your comments about African capital markets? Clearly, Citi's looking at supporting tech companies and other companies listing on global IPOs, UK and US. But what do you think needs to happen for tech companies to be able to access African capital markets and asset managers to help enable their growth?
Yes, very good question. And funny enough, just 2 hours ago, I was on a stock exchange conference together with Network International, which is a company I've referred a few times here, and the CEO, talking about IPOs in Africa. And so I would say that to do an IPO in London, for example, in the US, you have to have, let's say, five topics or 5 features. One is you have to have a track record, cannot be an idea. Public markets don't fund ideas. Venture capitalists do, not capital markets. So you have to have a track record. You have to have a strong growth profile. Not difficult, because these are all new stuff. And growth is very much at the DNA of these companies. But you have to show the case for growth, and that you are meeting someone else's needs that will bring you growth. Third, you have to have a great management team that can deliver, and can be seen as very credible. And fourth, you have to be realistic in terms of pricing. You cannot aim to take the very last cent from the public market investor. They will invest in you because they also want to make money. So you cannot expect to get everything at IPO. It's a journey. That's why it is called the IPO discount. You come in at a price that allows others to make, and then as you progress, price goes up. And finally, 5, you have to have the right set of governance, both internal in terms of reporting, audit, independent board members. Sometimes it's a little heavy, especially for a very entrepreneurial company, but it is a requirement. But also then in terms of the whole ESG space, which in fintech comes into sort of financial inclusion, and that whole space that is very important, and you need to show that that makes your business more sustainable and more successful. So I would say those 5 things.
Thank you. That's really helpful. Talking about governance and moving to the next speaker, Jorge is a fellow ex-Citibank who spent the last 4+ years building FinConnecta, which is systematically helping financial institutions and fintechs collaborate with their middleware. And he started his career at Citibank in risk management and credit, so clearly understands the nuts and bolts of what drives a lot of decisions in big financial institutions. Tell us your opening remarks, please.
Yeah, of course. And well, first, thank you for having me, and thank you for those participating and spending some time with us. This is an amazing topic, especially in Africa. I started my digital journey, I'm going to say, probably like 20 years ago. When I was in Citi, I was the head for Digital Bank for Latin America. And at the end of my journey in Citi, I was the head for FinTech globally. And when we started doing hackathons and collaboration initiatives in the world at Citi, we started in Africa. Well, first we started in Latin America, so that was the first test, but then we quickly jumped to Africa. And the reason for that is because we saw that Kenya was doing amazing things. This was a little bit after M-Pesa. And the funny story about that is that when I went to Citi's president, they say, hey, let's do an innovation program in Africa. And let's go to Kenya. And I remember he said, but wait a minute, we don't have a consumer business in Kenya. So the country is very small. Why do you want to do that? No, let's do it here in New York. And I'm like, yeah, I mean, New York is fine, but you're not going to find the kind of innovation that you will find in places like, of course, Kenya. No, and so we did many innovation programs in Africa. After that, we did in Kenya, we did it in South Africa, and then we started traveling around the region. So, and the reason why I'm saying that is because even though fintech in Africa is not as developed in other regions, it does have a very, very strong roots. You know, and the people in the region are very innovative. They do a lot with a lot less than other places. And we were just discussing before we started this panel, the level of seed and A round sizes and that we see in the region, an African region compared to others, is very small. So, and companies are able to build things with a lot less than in other places. So that helps ignite innovation. So when I started with all of this hackathons, thoughts, and collaboration, all of that, when I was at Citi, Africa was part of our starting process. So that's a little bit of story on how we started at Citi. The reason why Citi at the time, and Miguel might know this as well, we started doing hackathons and collaboration program, and this is back in 2012, 2013, was because we realized at Citibank that building technology alone will not take Citi too far, because Citi has this budget of billions of dollars, literally billions of dollars in technology development, but it's not enough, right? So at one point, I went to the senior management stuff and say, hey, we need to open doors and let third-party developers come, pull our information, and build for us. You know, and I'm not talking about fintech B2C. I'm talking fintech B2B. Okay.
Mhm.
And at first they thought I was kind of crazy. They said, "Hey, you need to talk to HR." But then after a couple of meetings, they said, "Okay, okay, let's spend some time on this." So we ended up opening APIs, right? So that was for us the big jump start of let's start collaborate. So that got me this idea of, hey, we need to build something that is not just for one bank at Citi, and that's how I left Citi years after that and created FinConnecta, right? And what FinConnecta does, for those that don't know us yet, is we are an integrated ecosystem where we plug in banks once and we plug fintechs once and we let the community do the business. So if you are a financial institution and you want to work with multiple fintechs, what you do today is you probably do integrations one by one, prioritization, a lot of investment, and then it's difficult for you to move forward. So now what we do as FinConnecta is we connect with the bank once, and through that single integration, we're able to integrate multiple fintechs. So basically, what we're doing is accelerating the process of collaboration and software as a service, and create a true ecosystem. And Miguel said something at the beginning that I think is extremely important, which is valuation, right? When we're looking at valuation of fintechs and banks, and what Miguel said is so right, and it's happening not just in Africa but everywhere. When we see the valuation of banks going down, because in general they are going down, and we see fintechs going up, there's only one answer to that, and that answer is the scale. Banks have proven to be not good at scaling. I mean, they were good at scaling before because they had a certain rate of scaling that it was good by for the time, right? So you will open branches and then you will start scaling, and the way we used to see scaling before. But now that doesn't cut, right? Because now you see companies on the fintech side that they're growing a million, 10 million, 100 million in 6 months, right? Banks cannot do that. And one of the reasons why banks cannot do that is because, and going to the topic of build, buy, and partner, right, is
Right.
because they're trying to build their own infrastructure. So for financial institutions that still believe that they have to build their infrastructure, what happens is that they are not able to gain scale. That's why their prices go down. So I might be oversimplifying this, but when you really analyze what's going on in the market and you compare banks and fintechs, you will realize that the big difference there is the capacity of scaling. So that's when we go to this topic of partnering, and we think, okay, so is there sort of like a hybrid, right? Because we're not going to say, okay, banks are not going to transform themselves into fintechs. That's not going to happen, no. But they can stop building on their own and start partnering more. And ideally, that will help them grow their business and start picking up some scale. Once they start showing scale to the market, the prices will start going up. So it is a complicated thing, but at the same time, it might be easier to simplify it if you start analyzing the big asset that you need to have today, which is your ability to innovate and your ability to scale. Okay, so that's in general how as FinConnecta we see the financial world going. And there's one more element that we should add, and I don't mean to talk about something that is kind of nascent, but I think that it's extremely important, which is DeFi, right? The decentralized finance to me is it's what's going to govern the financial world in 5 to 10 years from now. You know, DeFi has been growing so rapidly, and it's so amazingly well structured that I think that DeFi will become part of everyone's days, lives, and years to come. And if you put DeFi in all this idea of build, buy, and partner, that's the only way that financial institutions have to be part of that. That's the only way for they to really survive and being able to have their valuation grow. And maybe I'm going to stop there. I don't know if I in my 10 minutes, but yeah, so there's a lot to talk on this topic.
And before we move on to the next speaker, if I could just ask you one question. And when we're talking about banks partnering with fintechs, and thank you very much for really distilling the point about how that could help the bank's valuation. But one of the sticking points that I've seen in real life is if the bank's management KPIs are not adjusted to enable collaboration in this new territory. It's not about technology. Often it's about management incentives and structures and reward and recognition programs. So I'm wondering if you could speak to your experience in that space.
Of course. And thank you for asking that, because actually we think of digital as a technology discussion, and we work with many financial institutions around the world, and we have spoken with many of them in the region, in Africa and outside Africa. And when you start talking about digital transformation or digital programs or anything like that, they bring you the CTO. Right? They say, okay, you need to talk with this guy. And actually, the CTO is not the guy to talk with, and that's when you know that they have a problem, right? Because digitization, digital transformation, digital business, all of this isn't a strategic discussion, it's a business discussion. It's how you're going to go about building scale, right? And when you talk with financial institutions and they say, hey, I have 800,000 clients, and they think they have a good base, and they do, 800,000 clients, it's a nice number. And if they have 5 million, they say, oh my God, I have 5 million. And when you say, okay, do you know how many users, let's say PayPal has, right? And when you tell them, hey, when you digitize, are you trying to grow this on a 10% and 3 times type of ratio? That's when they start realizing that, wait a minute, that's not a discussion for the CTO, right? Because the CTO, they're amazing people and they know their job well, but they are the builders. They are the ones that have to help use the tools, but not defining what the tools will do, right? So all of this discussion of build, buy, digitization, partnering, and all of that, it's not a technology discussion. It's a way of doing business. And that's something that financial institutions need to get more comfortable with.
And if I could add, it's a commercial discussion, and for many African institutions, it's also part of their social contract to operate, right? Historically, the biggest banks in Africa have been the biggest and best employers. They provide a lot of skills training and development. But as they're looking to evaluate investment or partnership in new technology, it's going to displace some of their traditional jobs. So now what do we do about that? So it's, really, I think to insert here African social contract and the license to operate, and it comes with a lot of responsibilities for protecting the ecosystem and ensuring affordable digital financial services for many more people in the market. So if we can move on to Alina, who's the Chief Strategy Officer for Founders Factory Africa. I noticed that you started your career in the World Bank in Geneva, so clearly a world citizen, having spent a lot of time in Europe doing global partnerships before moving to Joburg to help set up Founders Factory Africa with great support from Standard Bank. So if you can talk to us about your experience with Build, Buy, and Partner.
Thank you, Margaret, and such a pleasure to be on this panel and to hear all the other speakers. And I think that it's a really, it's a really interesting discussion. I think there's a lot of sort of dialogue around what is partnership and what is partnership specifically within the fintech banks and telcos, and how that sort of illuminates itself across the emerging markets and other markets. You mentioned my time at the World Bank, and I was smiling because let me tell you a story. I mean, whilst I was there for quite a few years, and yes, indeed, I was based out of Geneva in Switzerland and working with the numerous organizations that are based out of Switzerland. So most of the World Trade Organization, World Health Organization, and others. The United Nations is of course there. You know, over and over again, there was this for a long time, and perhaps, you know, it's still part of the discussions and the dialogue is this kind of nexus between the private sector or the business community and the public sector or the development sector, you know, and it was quite prominent because, you know, we're trying to figure out how do we partner, how do we work better together between sort of the UN and all the specialized and the multilateral community with the private sector and the business community, and this feeling that the private sector has the capital and is very agile and is very dynamic, and the development sector has access to you know, these markets and governments, but doesn't have the other two. So how do we fit that gap? And it was on many people's minds, and I believe it perhaps still is. And then as I moved out of the development sector and into the, let's say, the venture capital, venture development world, and the world of innovation and entrepreneurship, I found myself in very similar conversations, because here I was talking to banks and corporates and other institutions going, here we are, and we've got this nexus between us, the big sort of mammoth tankers. How do we become more agile? How do we work better with the startups? You know, that the people who are sitting in the garage, who are disrupting us and who are creating these new solutions for consumers and are so digitally savvy and creating new technologies that are enabling them to scale, as Jorge spoke to, much quicker. And so it's interesting. And so I think, you know, what it highlights for me is that, you know, partnership and collaboration is at the heart of it. I think we'd all be kidding ourselves if we think that, you know, the UN or any other organization can fix all of our capital or other problems in emerging markets, or the private sector, or any corporate or any bank, or any fintech. So I think that this kind of triangle, a way of thinking about how we work all together as the enabling system is very important. And so let me tell you a little bit about Founders Factory Africa and what we do and how we think about and what's on our mind and what's on my mind a lot these days. Our focus is on building and scaling companies. Our focus is on early stage companies, so pre-Series A. And the reason that's our focus is because we believe very much, and again, emerging markets, but specifically in Africa, there is enormous opportunity to increase the pipeline of scaled companies. We were just talking earlier amongst ourselves about how many unicorns there are in Africa, and you can count them with one hand. Whereas if you look at other Asian markets, you obviously look at Europe, US, you know, there's tens and hundreds of them. And so the question is why? And for us at FFA, the answer is that because the early stage, the pre-Series A ventures, actually do not have the right access to capital, but also very clear support and very clear resources and infrastructure. And I want to sort of emphasize that it's not just we need more money, but it is very much about we need the right type of capital at the right time. And I think this is something that's kind of underlying at the moment in the ecosystem, is that when you look at a founder who has started and has a concept, and you look at the trajectory of growth of the venture from concept to pre-seed to seed, let's say super seed, pre-Series A and Series A, there's an enormous amount of variety there. And I think in Africa specifically, we haven't yet achieved clarity of mind of what each stage means, what the needs are, and what the evidence base is for it. In fact, we've just done a sort of a report with Brighter Bridges, a research company that sort of highlighted and illuminated, you know, that investors, whether it's VC or even angels, but mostly kind of the VC community, don't have the right terminology or framework to sort of understand or qualify what a seed stage company is. You know, for some the ticket sizes are 25,000. For others, it is up to $1 million. So, and that obviously affects valuations. And so I think there's an enormous amount of fragmentation in that very sort of phase of seed to Series A. Why is it important? Well, it's important because as the as partners, as that enabling ecosystem, it is our responsibility to create the right environment for these ventures to scale and to grow. And what that means, and this is where we play a role, is having the right investment, the right, obviously, sort of growth capital, the right scale capital, but also having the type of support that is perhaps missing for the early stage founders. So we are very much an intervention-based model. We are very hands-on with these founders and the founding team and the business itself. That means we've got a team of designers, data scientists, technologists, growth marketers, etc., working with these companies. Because if you're an early stage company, the chances are, you won't have access to a CTO or a CMO, or a product designer, or product developer, let alone sort of a data scientist, etc. And if you have access to them, the chances are you can't afford them. So that, that very, very quickly starts to affect the business in its growth trajectory. And the second thing, so tying the two together, making sure that the founders are developing the product and the technology based on a very clear market opportunity. So what is usually termed as the product to market fit, but tying that to very clear investment goals and milestones. So it's all very well to be building out a product or platform or an app or any piece of technology, but unless you tie it to very clear sort of your next raise or your next bridge round, you don't have that. You won't be able to sustainably get your business to that scale trajectory, and that's exactly what we focus on. I think the other thing that I sort of alluded to is knowing the market context is incredibly important, and I can't emphasize this enough. We're based in Johannesburg in South Africa. We're operating across sub-Saharan Africa. Being on the ground, knowing not only your businesses and the ventures, but also the users, knowing the landscape of Nairobi, of Addis, of Lagos, of Cape Town, etc. You need to be local, and you need to understand those nuances. You cannot do this, from an air-conditioned office elsewhere. So we are all building in market in Africa. So I think that's very important. Perhaps the last thing I would say is, as you've alluded to, Margaret, is what's really fascinating is to see our work with Standard Bank and our second investor, Netcare, as well. Yeah. So we are a corporate backed venture company. What that means is both Standard Bank Group and Netcare are our investors, our shareholders, and we work with them to catalyze both sort of on the startup side and on the bank side, clear opportunities, leveraging what Standard Bank brings to the table from an infrastructure, from technical expertise perspective, access to some of their customers through pilots, testing product, etc. And pairing that obviously with, again, the right needs of the business at the right time of their growth. I think the nuance here is, and I sort of wanted to highlight that, is there's kind of two different models of corporate innovation, if you like, and I see that as being very corporate focused, as in building things for the corporate and solving the corporate's sort of challenges, let's say. And there's the kind of the external innovation or corporate enabled innovation, which is you're leveraging the corporate's infrastructure, IP, assets, technical experts, but you're not necessarily building for the corporate. You're not building solutions for the corporate pain points. You're building for the market, and you're building for the consumers on the ground. So we're the latter. So whilst, and this is kudos to Standard Bank for understanding that actually scale comes from building for market opportunities. It is not looking internally, and it is looking at how we can leverage what we have, working with some of the smartest people within fintech, some of these early stage entrepreneurs, to actually develop solutions that are addressing very clear user problems across Africa. that.
No, absolutely. I think it was important that you made that differentiation between internal and externally funded innovation and understanding how you generate scale around that. I just wanted to comment when we were talking about unicorns. I think it's appropriate and necessary to talk about zebras as another measure of success on the continent, right? Not everyone who's starting out to solve a real market problem in Africa is trying to be a unicorn. Some think that it's appropriate, particularly since they may have to build the full tech stack and create other enabling solutions in the market to succeed, that there's different categories of success. And I think the zebra terminology is super relevant. If time permits, Aline, I'd like to come back later to talk about the UN SDGs as how private sector, government, investors, and entrepreneurs collaborate. But I want to give Rachel ample opportunity to tell the MFS story, because you as an organization in your 6+ years at the helm helping to grow MFS have had the opportunity to participate in each of those sectors. And I thought it was interesting. Rachel and I, we've been in many conferences in Joburg and other places, but have never had the chance to talk. So nice to finally meet you. But I saw you start your career at Millennium Corporation in Washington. So there will be some people who you may know from Washington tuning in now or to the recording.
All right.
Yeah.
Can you hear me okay?
Yep. No, that's great.
Great. Yeah, it's great to finally cross paths in this way. MFS Africa is it's really cool to be a part of this conversation, because we have the fortune and privilege of being able to sit in the on kind of both sides of many of these questions. So we are a startup now in our 10th year of operation. And for those who don't know MFS Africa, we are Africa's largest digital payments platform. We're a B2B interoperability platform. If you're in Kenya and you open the M-Pesa menu to send to MTN or Airtel Uganda, we are powering that transaction. That's our core business. We partner with diaspora-based MTOs to connect to our network of MNO networks connected to banks. So we have gone through the search for seed capital, and we've entertained multiple institutional investment and strategic investment discussions, the likes of which have been described here. We're very keenly aware of the opportunities and challenges that those kinds of investment perspectives bring. We've also made our own investments in the last couple of years, which I want to spend most of my time focusing on. In terms of partnerships, though, and as a way of expanding on our business model a little bit, I want to respond to Miguel's anecdote about we don't want to partner with banks, we want to disrupt the banks. And I think that certainly as a company that's very entrenched in the mobile money world, we are used to that kind of conventional wisdom of that the fintechs, the mobile money is going to come eat the bank's lunch. The fintechs are here to disrupt the banks. And I think that narrative has really changed in the last 3 or 4 years. I think banks are increasingly aware that there's room for everyone, and that it's not really about competing, rather partnering. So as an example, we have a Pan-African partnership with EcoBank Group. So in 20-something of their countries, we power bank to wallet, wallet to bank, and airtime purchase through their rapid transfer app. And that was an instance of a bank taking a digital first perspective of, we're not trying to make every single mobile money user in this market a banked customer. We see that our banked customers have a need to interact with unbanked or mobile money using customers. And we see it as a long tail opportunity towards customer acquisition. So we've been at the heart of some of those partnerships. Earlier this year, we purchased a company. We acquired Bionic, which is a fantastic SME payments platform. And what was really cool about that deal, and you can listen to more details on this deal on an episode of the Flip podcast that we did earlier this year, we solved the interoperability problem from a kind of outside in and cross-border perspective. They solve the interoperability problem from a primarily domestic and small business perspective. And the advantage of this deal was that both sides were very, very close to the tech and to the market. So not only were we really aligned in vision, but we also had a very, very clear and concrete view of the implementation of the synergies and how we would get there. The vision and value alignment was great in terms of how we act together if we disagree or if something goes badly. But when Miguel expressed the kind of exit and IPO challenge that a lot of African fintechs face, I think that one important lesson that our experience can bring to this discussion is that exits can also mean that the journey continues with another fintech that's in an adjacent part of the market. Another benefit or advantage of our investment acquisition process was that it was a much different type of decision process. So I think it was Miguel or Jorge who mentioned the decisions, the impetus to make decisions in New York for an African market. And even if those decisions are still being made on the continent, sometimes when those decisions come from a large institution, the number of people that need to be convinced and to buy in is just, can be literally orders of magnitude more than when it's a fellow player in the industry making the investment. So our experience really, for us, I think validates some of the earlier comments about the ability to innovate and wanting to make sure that the innovation doesn't stop after the acquisition. One of the kind of cautionary tales in our industry is of Fundamo, which was an amazingly innovative mobile money platform that was purchased by Visa and then put on the shelf. Nothing has been done with it. And so all of that energy, unfortunately, didn't get to reach the market after a certain point. The product continued to be used to a point, but it wasn't maintained. And now other players are in the space that Fundamo was. And it didn't get Visa what Visa wanted out of this. And I think that is in part due to just whether you're set up for innovation. The last point I want to make is about further investment in the ecosystem, not full acquisitions, but we at MFS Africa have what's called MFS Africa Frontiers, which is a bit of not quite a venture fund, but business development with capital. So we've made some minority investments in companies that are in adjacent relevant spaces where we can be not just a strategic partner in terms of expanding their payments platform, but we can actually help guide them in their startup and innovation journey. So 2 investments we've made public are Acorian, which is an ag tech company based in Uganda, and Inclusivity Solutions, headquartered in Cape Town, active across the continent, doing inclusive insurance products. So happy to take questions on any of the above, and thanks for the opportunity.
What is your selection criteria for investing and mentoring these companies?
I think selection criteria suggests a larger operation than we are, but our priority sectors are agriculture, insurance, healthcare, and identity. These are areas where we either see an obvious opportunity. We know that we won't be able to build that ourselves. There's no value in us building it ourselves, but we know that many people are building those solutions, and they're having to spend their time, in endless meetings to get a single M&O integration, and then to go to the next M&O integration, et cetera. And so we can be a kind of springboard to scale by offering our API, which connects to our entire network of 36 African countries, and we can also provide some advice, and in addition to the capital and the commercial arrangement to be their payments partner. So it would normally be, certainly companies working in Africa, companies working at a scale that who have a visible path to scale, and who are working on parts of the ecosystem where we can see payments being an accelerant.
Thank you. And Rachel, could you talk, since your MFS works across 36 markets, about the regulatory landscape in Africa and how you ensure scale when you have different regimes and regulations in each of these disparate markets?
Sure. Yeah. I should clarify that our company name is MFS Africa, not to be so that we're not confused with Doctors Without Borders. When we power services in 36 markets, and what that means is that we are partnered with regulated, licensed companies, such primarily mobile network operators. So if we take Move in Togo. So Move is the mobile network. They have a mobile money service. They are regulated by the BCAO, not only to do mobile money in the first place, so to be a deposit-taking entity, and to run an agent network. So they'll have that license before we even start talking. But they also have an approval from the BCAO, again in this case, to do cross-border payments over mobile. In this particular example, the BCAO limits mobile networks to in-zone transactions unless there is a partner bank in the mix. But by the same token, when we partner with Safaricom, they are regulated by the Bank of Kenya. And when we connect transactions coming in from World Remit, who's licensed in Europe and the UK, it's under those licenses that the transaction is regulated. We are licensed as a financial services intermediary, but we're not holding the customer funds. So we do face regulatory challenges, but mostly towards opening additional corridors. So we would love for every one of our 100 plus partners to connect to each other. Unfortunately, not only is there a regulatory obstacle to connecting, Malawi to Senegal, there also isn't a huge market for that corridor. But as we expand into more commercial merchant services, we will see that those transactions will not just be based on migration patterns, that we'll see an increasing demand to connect everyone to everyone, which is really our vision.
Brilliant. Thank you so much. I'm going to just take a moment and launch a poll that we put together to invite the audience to give us some feedback if they would. That's one of the downsides to obviously having a virtual event is we don't get to see the audience. I really want to know them. Great. So that's launch. Audience, please feel free to type your poll response. We'd love to hear from you. And if I could direct the regulatory question, Jorge, to you also, since you've had the opportunity to work across emerging markets globally, in thinking about the connecting financial institutions and fintechs in Africa, do you feel like regulatory barriers are a bigger deal than they might be in LATAM or Asia?
I think they're less of a problem as everyone would like to think. And when I say people would like to think, sometimes bankers, and I am a banker too, right? I come from a story of, so I'm not talking bad about bankers. I love bankers. I'm a banker, sure. But it's just that we always have worked around heavy regulation, and sometimes we tend to say that regulation doesn't allow for us to grow. And I think that's not necessarily true. I think it's a matter of how you innovate, how you truly partner. Because when we're talking about partnering, and what Rachel was talking about, it's you need to leverage different partners' abilities and assets. So when a financial institution partners with a fintech, and the fintech is providing B2B services, the regulatory scheme is not as complex because the financial institution is the one that has the license, they're regulated, they know how to do this. One of the biggest assets that financial institutions have is this knowledge of compliance. They compliance. That's what they actually do, right? They are good at talking to the regulator and all of that. Fintechs are good at innovating and creating new technology. So that's the partnership that you have to look for. When fintechs start trying to solve the regulatory issue and they're trying to come up with ways that they have to have the license everywhere where they want to operate, then they start to getting into this discussion that they shouldn't be in. You know, I when I was talking about valuation, one of the topics that to me are extremely important when you think about valuation is your ability to scale. So partnership should give you the ability to scale. And when we're talking about regulatory issues, you have to be innovative to solve for compliance and regulatory issues. I'm not saying that you have to go around regulation, by no means. It's just that different partners bring different expertise and they bring assets to the table. So the way to solve for regulation is not to talk with regulators, is not to try to change the regulation, because that means years, right? And that means 50 regulatory agencies throughout the region. I'm talking Africa. So how are you gonna solve for that? Maybe by 2040, when you meet again in 2040, or you meet with my then well, we're not gonna be there yet, right? So we need to solve for regulatory issues in the next 12 months. The way to solve for that is partnership. It's not going and trying to change the regulatory environment. Forget about that. There's too much money to be spent on that, too much time. It's too narrowly focused on one specific geography, because if you want to solve regulation in Kenya, you have to go and talk to the regulator in Kenya. Then you go to Ghana, then you go to Ethiopia, then it's a never-ending story. So my advice to those of you that want to really gain scale and you want to solve for regulation, think different, innovate, partner, and try to find ways to how can you gain scale without having to go and change something that you don't have the power to do so.
Thank you. That was really practical advice. And just observing the participant list for the event, it was really heartening to see quite a few African regulators signed up to participate in the summit, and the Mauritius government sandbox represented too. So I think, although you're absolutely right that changing regulation is a very long-term and expensive, time-consuming process, there's a growing willingness in some African jurisdictions to collaborate with the private sector, as long as we're working to a goal that is actually, again, providing more affordable, secure services to the majority of the population. We are almost out of time. I think we said we had 50 minutes, so we're over time. Alina, is there any closing statement you wanted to share with the group?
I think it's been a really healthy and very interesting discussion. I was making notes as everybody was speaking. Couldn't agree with you more, Margaret, about the sandbox piece. And I think Ethiopia and South Africa has made strides in that way. I think that the sort of the word or the message that stood out for me when thinking about this topic and building things, partnering, buying, M&A, growing, scaling, corporates, fintechs, is risk. And I think more than anything, I think it is having appetite to take risk and making incremental changes or iterations and pivots, adapting. Here we are talking via a platform when in reality we would have been together in a pandemic. So I think taking risks, and it's both for corporates and large institutions, but it's also for startups, because I think a lot of the time when opportunity arises, we as human beings want to get to the answer before figuring out and testing some of those solutions. So taking risk for me is what will lead to scale and to better and more quality partnerships and strategic alliances.
Well, thank you. And we have a really exciting day ahead of us with a number of panels, and Jack Dorsey gracing a keynote address later today. So let's tune in to the next session. And thank you, panelists, for your time and attention. And audience, we're disappointed not to have questions from you, but hopefully we can be reached on LinkedIn. And I just wanted to encourage the other speakers. You mentioned some research reports and podcasts. And if you would do us a favor and just reference those on your LinkedIn profile so the audience can access that information, I think that'd be really valuable.
Super.
Thank you.
Thank you.
Thank you, everyone.
Thanks all.
Bye.